It's now 9 a.m. Pacific, so let's go ahead and kick things off. We can see a number of attendees are still arriving, but we'll get started. And I'd like to begin with saying good morning and good afternoon or good evening, everyone, depending on where you're joining us from around the world. My name is Richard Anderson, and I'm the founder and CEO of ShareVault. It's my pleasure to welcome you to another one of our many thought leadership webinars. Over the past several years, we've hosted webinars and panel discussions covering a wide array of business topics, including M&A, working capital management, fundraising, and cybersecurity, just to name a few. Today, we take a look at alternative public offerings with a special focus on special purpose acquisition companies and reverse mergers, with a distinguished panel of experts immersed in the sector. On behalf of the many contributors who have collaborated to make this event possible, I thank you for joining us. This is the 80th in ShareVault's webinar series, and today's topic is reverse mergers and SPACs. Are alternative public offerings the new norm for biotechs going public? Based on the large number of registrations for this discussion, this is clearly a popular and timely topic. Today's panel discussion is hosted by ShareVault. Many of you in the audience may already know about ShareVault's leadership as a provider of secure, cloud-based business file sharing software and virtual data rooms for a wide variety of business due diligence applications, including M&A, partnering, and financing and licensing, board communications, vendor and other third-party collaborations, and also to maintain a secure and organized central repository for all business critical documents. ShareVault also complements the tools you're already using, such as Box, Dropbox, Google Drive, Office 365, SharePoint, and DocuSign. ShareVault enables customers to experience a positive business impact because we accelerate due diligence, reduce risk, increase productivity and efficiency, and reduce cost. If you haven't experienced our cloud-based solutions firsthand, please reach out to us and schedule a demo or help us set up a free trial for you. Visit us online at sharevault.com. It is my pleasure to introduce our moderator, Scott Jordan. Scott Jordan is the founder of S. Jordan Associates, a life sciences investment bank. Scott has over 30 years of experience in the life science industry, including as a C-level executive, investment banker, and in senior marketing and business development roles. Most recently, Scott was Chief Business Officer and Chief Financial Officer of some promising early stage companies located in Houston, Texas, namely Iterion Therapeutics and Solaris Pharmaceuticals, where he arranged non-dilutive financing from the Cancer Prevention Research Institute of Texas. Scott's efforts at Solaris included raising Series 1 and A financing rounds and advancing the company's lead asset into phase 1 and 2 clinical trials in the rare orphan disease area of Ewing sarcoma. As a result of the company achieving pivotal financing and scientific milestones, Solaris listed on NASDAQ via reverse merger with Flex Pharma in July of 2019. Scott, the podium is yours.
Thanks, Richard. Thanks for the introduction. It's my pleasure to introduce our distinguished panelists. Each one of these individuals has a very strong track record of advising, preparing, identifying, and most importantly, winning and closing alternative public offerings. So we're on our panel. We have David Strupp, Scott Jansen, Stephen Alicanti, and Michael Montgomery. So I'm going to take each one of them, have them introduce themselves. We'll start with David Strupp, who's the co-chief executive officer of Ignite Acquisition Corp. David?
Apologies, let me unmute. Thanks, Scott. Again, David Strupp. I'm pleased to be on this panel today. I look forward to speaking about both SPACs and reverse mergers. I've been a healthcare banker now for 28 years. Currently carry two titles. One is, as Scott mentioned, is co-CEO of Ignite Acquisition Corp. Ignite is a SPAC that was formed early this year. We have $57.5 million in trust. Looking for merger targets in the life sciences space. We're actively out right now, trying to consummate a transaction. And then my other title is Head of Healthcare Investment Banking at Ladenburg Thalmann. Been there in that capacity for 9 years now. And we've developed a market-leading practice in advising companies in reverse merger transactions. Over the course of the last handful of years, have done 18 such transactions, and that's a business that's accelerated for us. We did 6 just last year, and 1 just a few weeks ago. So excited to be on this panel. Thank you, Scott.
Thanks, David. Appreciate it. Next up is Scott Jansen. He's the managing director of LS Associates. Scott?
Thank you, Scott. So pleasure to be here for sure. As you mentioned, my group, LS Associates, is a group of C-level leaders who provide interim solutions to the life science industry. I'm a CPA. I've been through several IPO transactions and a reverse merger in my 30-year career. And right now, as myself and my group, we're currently working with several companies as they prepare for their public company transitions, both through de-SPACing process and several IPOs that we're working on. My group, Ellis Associates, is part of a larger platform underneath the LifeSci Partner platform. LifeSci Partners has over 200 clients, both private and public, and we provide IR, PR, executive search, and partnering analytics services. I'm also, again, dual hats. I'm on the board of LifeSci Acquisition Corp. 2. It's a SPAC, which is currently trading under the symbol LSAQ, and we're currently interviewing merger candidates. So thanks.
Thanks, Scott. Next up, Stephen Alicanti, partner, DLA Piper.
Thanks, Scott, and good morning, everyone. I'm a corporate and securities lawyer based in New York. Over the past few years, my practice has been consumed by SPACs, given the activity in the market. I've probably worked on a couple of dozen SPAC transactions along a variety of touch points, working on the IPOs up front, to the PIPE transactions, to the back-end business combinations, and then also working on the post-closing public company after those transactions. We've worked with a variety of participants in the transactions, including investors, the SPACs, the investment banks, as well as the operating company. So looking forward to speaking with this great panel today. Thanks.
Yeah, thanks a lot, Steve. And last but not least, Mike Montgomery, managing partner, Effectus Group.
Thank you, Scott. I appreciate the opportunity to speak with the group. I'm the managing partner of Effectus Group, which is an accounting advisory services firm. We primarily work with high growth life science and technology companies and help them navigate the SPAC process, traditional IPOs, and M&A transactions. Our firm's comprised of all former Big Four auditors, now turned consultants, and we're headquartered in the San Francisco Bay Area, many offices in different strategic markets, and are working with many clients right now going through the de-SPAC process. Our firm primarily focuses on the de-SPAC process, and so we'll talk about that a little bit more in detail today, but we probably have somewhere between 20 and 30 clients right now in different stages of that process. So, plenty of experience in that regard. So I'm excited to be speaking with the panel today.
Thanks, Mike. I appreciate it. So the agenda looking forward today, we're going to do three things. First of all, Scott Jansen, Managing Director, LS Associates, is going to give us a State of the Union address, which is kind of like the landscape, the SPAC landscape. Secondly, we're going to have about a 25 to 30 minute open table discussion where we're going to talk about five topics. We're going to talk about understanding, prepping, identifying, winning, and managing a SPAC transaction. And then we're going to follow it with case studies. Scott Jansen's going to show us, illustrate a example of a successful SPAC between LifeSci Acquisition Corp. 1 and Visera Pharma, followed up by David Strupp is going to talk about Kick Unum Pharmaceuticals. That's going to be a reverse merger example. So let's do this. We're going to hand it off now to Scott Jansen, who put together 3 slides for us on the State of the Union, AKA the SPAC landscape. Scott?
Exactly. Thank you. So these 3 slides have a ton of information. I'm going to just kind of hit a couple key highlights for everybody, which I think are relevant. So to bring this out, this information is year to date from 2020 for this year, 2021 through early March. Hasn't been updated in the last week or so. But they are materially and directionally accurate for sure. So just in Q1 so far this year, the market has added 32 SPACs with over $7 billion of available capital. And then if you go back, look back 2 years, 32 SPACs have announced or closed on their mergers with their operating companies. And if you look at the performance, it's good to decent. The average performance is 28% with a median of almost 9% performance upside. So looking pretty good. A key metric, I think, for those of you looking to merge into a SPAC here, if you go down to the next box there are 57 open SPACs trading with various amounts in trust. And we'll dive into a little bit more detail in the next 2 slides. But the average amount of trust is 200 million. So that's the capital sitting there at the average at a SPAC for you companies if you want to de-SPAC and merge into it. So nice numbers there. One attribute I want to point out is that SPACs only have a 24-month life or shelf life from the date that they IPO. So they need to find a merger candidate in that time frame. And so if you look at this next box, you can kind of see the shelf life of these SPACs. And the good news for companies who are looking to merge into SPACs is a lot of SPACs have time. So that's good. But there are some SPACs that are running out of time. So those might be opportunities to merge with sooner. They might be looking for somebody because they need to get that done. The last box here on this slide shows the attributes of one of the latest de-SPAC mergers and the mechanics of how ATI Physical combined with the SPAC. So ATI merged, de-SPAC'd with the SPAC, and they combined the company and the funds that are in trust. Now, also note, we're going to talk about this today as well. They did a concurrent financing of 300 million. So the company, the SPAC, the number of trust, and then you bolted on another 300 million. So I want to point this one out. This is a larger transaction in part because of the size of ATI. It's public information. They have over 900 sites operating in 25 states. So they're a pretty robust operating entity. So when they came into the de-SPAC transaction, they already had $1 billion value. So, but just kind of wanted to just showcase the mechanics of that here. Anybody, before I move on, any other comments or things to highlight here, gents?
I just make the comment that it's a startling statistic that there's 57 healthcare SPACs in the market right now, and 37 of those were just birthed this year. And that to me is pretty striking, and it shows the sort of the acceleration of this market that we're all catching our attention. But that to me was a pretty startling statistic.
Yeah, and $7 billion are available out there. Added for companies to merge into. So that's really good news for companies. Let's move on to the next slide. So a lot of numbers here. Just kind of want to highlight a couple things. This is these are the closed deals in the biotech sector. We've got two sectors, biotech and then healthcare on the next slide. So I want to kind of point out what's happened, a couple things here, and then kind of contrast them to healthcare. So for biotech, you can see the median pre-money valuation is 350 million. You're going to see in healthcare, an ATI Physical is one of those where healthcare is going to be a little bit larger. But if you're in biotech, the median pre-money is 350, combining with a median cash and trust of 70 million. So that's kind of the median deal size just for everybody out there. The concurrent financing varies here, both in size and whether it was a necessity for these biotech mergers. Sometimes it was, sometimes it wasn't. So more to come in the seminar about the requirements and the process on how you want to combine concurrent financing with your de-SPAC merger with a SPAC. Okay, also note here, I want to point out that this slide has some detailed performance of the SPACs post-merger. So the company and the SPAC merge, and then where's the company doing after that? You can see the mergers reflect the ability. The key here is the mergers, and that now the stock price reflects the ability of both parties involved, both the SPAC sponsor and the operating company. So you want to build confidence with the current investor base, and then you want to create a robust investor relations strategy pre and post merger, so that you have this long tail after the merger to allow the SPAC investors with your new investors, maybe with the concurrent financing, and now your retail investors to understand the story and understand the value of these two combining together to create the long-term value as you operate as a public company. So far so good if you look at some of these performances. Let's move on to the next slide. Again, all those same comments apply. I want to just kind of note that the pre-money, the median pre-money valuation here in healthcare is about 5 times higher than biotech. So the pre-money is about $1.5 billion. Median in cash and trust is close to 500 million. So these are all bigger. Also to note, kind of the bigger deals and the larger your company's valuation going in, most of these companies, if not just almost all of them, had concurrent financings. So that was kind of important for these companies because most of them are operating already and get that concurrent financing and ability to come in there, which is nice. And then the concurrent financing also adds additional investors to the company, which are going to help that. Again, we talked about that long tail just a minute ago to help the company's value head up and to the right as you're a public company. So those are my comments. I'll kind of hand it back over to you, the panel, and for any other additional comments, and then to Scott.
Well, one of the comments I wanted to make was if as an emerging growth executive, right, and you have a valuation of your company sub 100 million, you have to ask yourself, am I really a good candidate for a SPAC when the typical SPAC is looking for a company with a pre-money valuation of anywhere between 3 to 5 times the amount in trust? So I think the odds are against smaller companies, more micro caps to do a SPAC. There are instances where it has been closed. For example, LifeSci Acquisition Corp was more of a 50-50 deal that Scott did. But I would say that if you're 150 to 200 million dollars and above, I think you have a higher probability of closing a SPAC transaction. David Strupp, would you agree with that assessment?
Yeah, and I would. It's also, I was struck by this one. I'm sitting here writing this down because I was struck by this one statistic up here of concurrent financing, 529 million on average. Now it's way, there's one there that's quite large. So even if you look at the median at 188 plus the 294 in trust, those are big numbers, right? I mean, you're birthing a company with $400 million, or if you look at the average, it's close to $1 billion of new capital from cash and trust plus the concurrent pipe. Not every, it's interesting for me because I'm out there talking to private companies right now. And we talk about the pipe, and the companies are saying, well, geez, why would I do the pipe? Because I don't need that much money, and that's dilutive. And so I think one thing that's going to come through is SPACs aren't for everybody, right? They're clearly, we're talking about a lot of new cash, and that is going to be great for some companies, but perhaps too dilutive for others.
Agreed.
Okay, excellent. Okay, let's move on, guys. We're going to move on to our open table discussion. Now, keep in mind the questions that are going to be posed here by myself to the panelists. We also encourage questions to come in. We'll do our best to answer those questions, and we'll get a list of those questions and respond to you following the webinar. But the key here is this is the pathway to the public markets via an alternative public offering. There's 5 facets here. It really is linear to a certain degree. You start off with the understanding of what is a SPAC, how does it operate? Stephen Alicanti is going to address a lot of those kind of what is a SPAC, how does it work? Then we get into prepping, right? And Scott Jansen, Mike Montgomery are going to play pivotal roles here, talking about how do you prep for a SPAC. Then you move, once you've prepped for a SPAC, how do you identify a SPAC or reverse merger opportunities? And David and myself will chime in there as well. And then you go into winning. So you've identified, you're in the process, you're in the auction. Can you win? How do you win, right? And that's obviously what we're all focused on, is winning. And that means you've been selected by the reverse of the SPAC sponsor. And then once you win, though, how do you manage the process? How do you maintain the value of the company? How do you make it so that you get the post support like you would get with an initial public offering? These are all things we're going to talk about. Okay, so we're going to open up with this open table discussion. Panelists, if you'd come off mute, because we're going to take about the next 20, 25 minutes kind of going through these different topics. We're going to start with you, Steve, under the understanding. We're going to take about 10 minutes to do this. Tell the audience, what is an APO what is an APO, reverse merger SPAC? How does it work?
Sure. So thanks, Scott. And by way of introduction, these are all truly alternative ways of bringing a private company public. I'll focus on SPACs given the results of the poll, and it's just a very hot area at the moment. There's a significant degree of overlap between a SPAC and a reverse merger, but there are some important nuances between them. A SPAC is ultimately a new vehicle. It's a blind pool. It's formed by a sponsor group that is marketing an IPO for the SPAC itself. And it's going out and saying, we're going to focus on life sciences companies between X and Y valuation. They're marketing their IPO based on the track record of the executive team. Frequently, it's executive officers, directors, and an advisory board in many of these transactions. And And investors are buying into that SPAC IPO with the expectation and the hope that that management team identifies a target that is going to be public company ready and that it is going to trade well after the closing of the de-SPAC combination, business combination. So there's a couple of steps in that process to really understanding how a SPAC works. The first step is that IPO. When the sponsor group markets the deal with an investment bank, the initial SPAC IPO, a target is not identified at that point. There are strict rules against pre-identifying a target when a SPAC is going public. This is truly a blind pool. The proceeds from the SPAC's IPO are deposited into a trust account. And that trust account is generally only released upon the successful closing of a business combination, or as Scott mentioned earlier, SPACs generally have a limited life cycle. They're usually 18 to 24 months. And if the SPAC doesn't receive an extension at the end of that life cycle, they're required to return the proceeds from the IPO to the common shareholders. So after the SPAC goes public, it uses the proceeds in the trust account as dry powder for an acquisition target. It'll go out and it'll interview and meet with a number of different target companies, ultimately enter into an LOI, maybe several LOIs during the course of the process. It will conduct due diligence of the target company, and then it'll commence the process of negotiating definitive deal documentation. Generally, once an LOI is signed, there's often a concurrent financing, which was alluded to earlier. That concurrent financing can take a number of different shapes and forms, but oftentimes there's an investor presentation, which is based on the target company, because that's ultimately what investors are going to decide. They're going to stay in the deal or they're going to get out and say they want their money back. So investors will be meeting with the management team of the private target, as well as some representatives from the SPAC itself, determining whether or not they're going to invest in the SPAC. Some alternatives you'll see existing investors in the SPAC agree not to redeem, and I'll get into the redemption mechanics in a few moments. So the paradigm that is often recommended is that the SPAC will announce the definitive deal documents with a private SPAC target and a concurrent financing. The concurrent financing, in addition to providing the capital stack for that transaction, it's also validation. It's showing that you have institutional support behind your deal. They believe in this target company, that it's public company ready, and that they're going to buy in and they're going to stay in the transaction once this private company becomes public. So hopefully you announce your deal, you announce your concurrent financing, and the stock price of the SPAC will begin to trade up. So a SPAC IPO is typically priced at $10 per unit. It includes common stock and some degree of warrant coverage. You'll see serial sponsor as the warrant coverage kind of is reduced over time, but you'll see a variety of frills around that structure. So after the deal is announced, there's another kind of friction point that everyone's focused on. It's redemptions and voting. So the stockholders of the SPAC will have an opportunity to examine this deal, and they're going to say, we believe in this private company, we're not going to redeem. Or they can say, we don't like the looks of this company, we want our money back. So they can submit a request to the company and say, I want my pro rata share of the trust returned to me, and I'll give up my common shares. Then there's also a stockholder vote. In most instances, you'll see the SPAC stockholders have to vote in favor of the transaction. We could talk about the dynamics between the vote and the redemptions a little later on. But assuming your redemption threshold is sufficiently low, many of these deals have minimum cash conditions so that if the trust gets wiped out, the deal won't close. So you want a sufficient number of people to stay in the deal so that you have the cash proceeds sufficient to close, and you also have sufficient public float once the deal closes and the stock trades on the other side of your de-SPAC transaction. So generally you get through the redemption deadline, shareholder vote, the deal will close very shortly after the vote, assuming everything goes well. You'll have a sense pretty early on, once your deal is announced, where things are trading. As I mentioned earlier, the unit price is $10 a share at the IPO. We're in a very low interest rate environment. So if your deal is hovering at or below trust, you could be in some trouble. If your deal is announced, the stock trades up to 12 or 13, you can be pretty confident that your redemptions are going to be low and you'll be able to close your deal.
Thanks, Steve. Hey, David, let's talk about the advantages real quickly and disadvantages of going public via SPAC, reverse merger, or IPO.
Yeah, I'm going to start by saying there's a lot of similarities, right? I think that the timelines for executing any of these transactions are largely similar. The costs are largely similar. One of the key differences, though, is sort of the timing of kind of that important event of raising the capital. In a traditional IPO, it's all front loaded, right? You begin with the diligence and the S1 documentation process, going through the SEC, getting out of the SEC. Of course, there's test the waters along the way, but you're really beholden to that investor roadshow on the last, call it 5 to 8 days, at the very tail end of that process. If you were a company, establishing, having an organizational meeting with your bankers today to kickstart an IPO process, you're probably talking about being public in, call it the July timeframe, and who knows what the market's going to look like in July. If you're a company that has executed a term sheet in a SPAC today, you're going out and first of all, you negotiated valuation today, and then you're marketing that transaction to PIPE investors. And prior to signing the merger agreement, typically, you'd have stock purchase agreements for the concurrent PIPE that basically validate that the valuation that you've agreed to, and you pretty much will have the entire transaction baked. Let's call it, if you were starting today, by mid-April, and then you do the back end work that Steve explained of sort of working through the SEC and getting the deal closed. But it's just sort of a timing differential of back end versus front end, and negotiated versus sort of market dependent.
Excellent, David. Appreciate it. We're going to jump ahead real quick. We're going to go to prepping. Okay, next 5 minutes. Prepping for an alternative public offering. Keep in mind, one of the key aspects that listeners should think about is have the key stakeholders of your company met and agreed on the path forward for the company to raise the funds needed to fuel growth. So during my experience taking a company public via reverse merger with Flex Pharma, when I was Chief Business Officer of Solaris Pharmaceuticals, and David Arthur, actually CEO, is on this call, one of the things that we did is we strategically looked at the different options of scaling capital, and reverse mergers was one of those. So we did a lot of prep work in that process. So Scott Jansen, question for you. If the path forward includes an alternative public offering, how important is it for the company to assign a leader or project owner to ensure the company is prepping for one of these paths?
Yeah, it's incredibly important. The company should be leaning in to their financing event, whether it's maybe a dual tri-track, right? IPO, SPAC, a reverse merger. And I rode crew. That was my sport in high school and college, and so I love the oars in the water together, right? So it's having, when you're rowing crew, we're actually not facing where we're going. So you need that coxswain to be steering you and guiding you and navigating the race and making sure you don't bump into stuff. So, and also helping call out the cadence and holding people accountable. So it's super important to have a project owner. And that can look in a variety of different forms. Number one, it could be the CEO or the CFO of the company, right? The founder, to make sure that he or she's talking to the board, talking to the current investors, and then looking around to who else I need in my boat as I move forward, right? And we talked earlier about being public company ready. So you need to make sure on your boat you've got auditors and technical accounting consultants and attorneys. Maybe you're getting some investment banking advice and investor relations as well. So if you're leaning going into the public markets, you need to make sure you have a really strong strategy around IR, pre, during, and post merger or IPO. So it's very incredibly important. I know for my group, specifically, a lot of times we come in and we act as the project manager, we act as the coxswain to make sure that all the members in the boat are moving forward and holding people accountable. So it's very important to have that project.
Yeah, thanks, Scott. Appreciate it. Mike, how are you advising clients to prep for the path forward and differences in preparation between an IPO, a SPAC, and reverse merger?
Yeah, thanks, Scott. It's really interesting. There's two types of calls that we receive. There's one call that kind of goes along the lines of, hey, we're a high growth company. We're looking at doing an IPO, maybe 2 years out. We'd like to have some thoughts from your team and from you on preparing for an IPO and what that looks like. And, maybe we can meet over the next few weeks to find some time to do that. Sorry about that. My light went off right at the wrong time. The second type of call is really, hey, we're in negotiations for a term sheet today. We're expecting to sign that this week. We need to get an audit started, and we'd like to close within the next 1 to 2 months. Those calls are very different, and it really just comes down to time. So traditional IPO, it's really about people, processes, and technology, and putting in the right kind of roadmap for the next 18 months. Hiring the right team that can help you go public, probably a change in ERP perhaps, process improvement, making sure you can do a close going from maybe 30 days or more, perhaps down to 10 days, in kind of a best case scenario. For a SPAC transaction or reverse merger, it's really about just execution, right? And so Scott Jansen mentioned this, but there needs to be a strong project manager in place that understands the process, that can manage the different parties, including the different advisors that are involved. And really execution is key. And, that's really sort of what it comes down to at the end of the day, is less focus on prep at that point and more focus on execution.
And I think a good point to highlight, there's 3 alternatives. If you're looking at an IPO or reverse merger or a SPAC, a lot of that prep that you're doing up front can be utilized for each one of those work streams. So it's not wasted effort. So get Mike and Scott and their teams involved early on and start the process for becoming a public company ahead of time.
Yeah, Steve, that's a great point too. We run a prep process in the background on a SPAC transaction. So for example, a lot of companies will have to do an ERP implementation. It's not the most critical item during the SPAC process, but it's also important and needs to be done. So it's kind of a back end part of the process that we also run. Great point, Stephen.
Yeah, exactly. Totally concur. And it's less expensive, right? Some people, they think it's going to be expensive to start. Well, it's more expensive, Mike, when you get that call when it's everybody's hair's on fire rather than it's an 18-month ahead of time, right? So save yourself some money and start prepping it. And I'll even say, it's not a topic here, but M&A, right? So even if you think you're going to be bought, a lot of the same processes that you're setting up, the close and getting yourself ready for even M&A is the same. So start early.
Okay, thanks guys, appreciate it. All right, so now we have an understanding of what a SPAC is, reverse merger. We've prepped for it, right? Now we're going to try to identify. So David Strupp, from your investment banking experience, how can executives identify the right SPAC or SPACs?
Yeah, that's a good question. So I mean, it begins with, Scott showed us 57 SPACs that are out there in the healthcare space. That's a subset of all of the SPACs. I don't know what the number is right now of the total active SPACs, but it's a multiple of that number. So you first need to begin, sort of narrowing that subset from 57 down to, if you're a company in the healthcare space, what kind of company are you? Are you biotech, device, diagnostics, et cetera? Most of the SPACs will have some kind of a focus. Some might be broad-based, and others might be more narrow. So that would be it, is to sort of identify, if you're a biotech company, which SPACs are specifically guided towards trying to identify biotech candidates. And now that's a new pool. And now what's the size, right? Does it have $50 million in trust or $250 million in trust? And so, those are the kinds of dynamics you need to work through to figure out whether or not it's going to be the right fit for you and your needs. And then there's sort of, second order issues of, what does the SPAC itself look like? Does it have warrant coverage? Who are the investors in the SPAC? Does the team in the SPAC add value to what you're trying to accomplish? And then, you want to get down to the third order, you really have to get on the phone with the SPAC team, get to know them, figure out whether or not somebody you can transact with. So there's a whole bunch of things, but it really begins at the top until you get down to a manageable pool that you can directly interact with.
Okay, let's flip it around. So as a sponsor, David, with Ignite, can you also comment on how you market Ignite to potential merger candidates?
Yeah, we take a very different approach. I think it's, so this may not be helpful for the broader perspective because we've sort of flipped it around. Our view, I sort of wear my M&A hat as the from my Ladenburg, seat as the CEO of Ignite, where our view is we're going out broadly. So I'd say by now we've kind of reached out to 300 companies in the life sciences universe. And we have a process letter out there. Our bid date is next Wednesday, March 24th. So we are looking for companies to make proposals to us about a merger with Ignite. We want everything fleshed out in terms of their thoughts on valuation for themselves, guidance towards their ability to bring pipe financing, et cetera. And once we've received the inbound, we'll then begin to sort of narrow the scope to a more manageable pool of companies with which we want to directly interact and try to figure out whether or not that company is a good fit with us, and marketing ourselves then to them and saying, here's why we are a good fit for you, and starting to have that direct interaction. But again, trying to avoid talking to 300 companies so that we can focus our time on 5-10 companies that we think are particularly good fits for our SPAC.
Okay, David, thanks. So we're going to jump to winning. I mean, one of the things I'll talk about as an investment banker and having actually taken a company public via reverse merger, and that is the importance of concurrent financing. It cannot be understated. The majority of the SPACs or reverse mergers have concurrent financing. You have to ask yourself why, and it's price validation, right? Especially in the SPAC area where the sponsors have an incentive to do a deal because they get to promote. Sufficient capital to a milestone, support aftermarket support, and offset redemptions. Those are all the reasons. Then you ask yourself, well, how do I find these concurrent? Well, you can work with a banker that has relationships. You also, it's publicly disclosed, right? Who are the concurrent financings? You can reach out and establish relationships with them as well. But as we take a look at winning for the next few minutes, David, as a SPAC sponsor at Ignite, what makes a company a strong candidate for a SPAC transaction?
Yeah, I mean, I'm actually going to answer that question from my other seat, from Ladenburg. It's interesting. I wouldn't even take on a private company as a client who came to me and said, geez, I want to go, can you please help me identify a reverse merger candidate or a SPAC? That to me is an uninteresting banking task. Why? Because the competitive profile is so competitive. Your odds of success are so low. And the only companies that I take on as clients to do that are the ones where I have a high degree of confidence that I can go raise the pipe capital. And the way I would approach that is actually go focus on that first. I would go find the pipe investors. And we did this a year ago for a company called Artara, where we went out and the first thing we did was we got term sheets for $42.5 million from some of the premier healthcare investors out there. And then we went out looking for merger candidates, and the first door we knocked on opened up, and we transacted with them. So from my perspective, if you're showing up on the doorstep and you already have kind of that investor syndicate supporting your going public transaction, you're necessarily going to rise to the top of any stack of candidates being evaluated.
I strongly agree with that, David. That's a very rare situation, and it puts you so far ahead of your competitors if you can have a prearranged pipe like that. You're in pole position with that situation.
I'm gonna pose this next question to
for the IPO.
Scott, did you want to follow that up?
I was just going to say it gives you that optionality too, David. Right? Yeah.
Yeah, you can go down any path. You can do the IPO path. You can stay private with the crossover. Absolutely.
So I'm going to pose the question to Mike and to Steve here. In your experience, what are the gating, or let's talk about the negating factors that might disqualify a company from merging? Let's start with you, Mike.
Yeah, I think, and David talked about this a little bit, but just overall timeline is probably the largest gating factor. There are just some SPACs that don't have enough time to work with a company that is underprepared. For example, I'll just give an example, and this is from my lens from an accounting and finance standpoint, but, and many people on the call probably deal with this or dealing with this right now, but audits just tend to take time to get done, and regardless of how well prepared you are, hiccups happen during the process. And so for a company that's just starting a first-time audit, never been through it before, has a small finance and accounting team, it's a tough road. And so if a SPAC is 12 to 18 months into their 24-month life cycle, you just won't be a very interesting target for them. It just really can't happen. So although the stats were very sort of reassuring that Scott Jansen shared earlier, that there's many that have gone public, in the last recent months. So that may be less of a factor for a lot of earlier stage life science companies that are out looking. But I'd say timeline is probably the biggest factor, at least from my point of view. Companies that lack an FP&A process or an ability to forecast, and for life science companies, most that are in this stage probably aren't as focused on revenue, I would say, but really the ability to forecast key milestones of development and the related costs that go into that development is probably one area that will be largely scrutinized by potential sponsors. Another one is just the experience of the management team. For a target company that has executives that have never gone through a public company transaction, that can be a limiting factor or a gating factor. And probably the last one I would say is we've talked about this sort of extensively, but just the valuation of the target itself. The post-merger value of the deal, roughly 80% of that should come from the target company itself. So you can kind of size yourself up by looking at the trust assets of a SPAC, and you'll know pretty quickly whether or not you're a target for that SPAC or not. And that varies. 80% isn't sort of like a hard line rule. I think Scott Jordan mentioned 3 to 5 times that. So in some cases, but that's kind of how you can size yourself up, whether or not, the valuation of your company itself would be a gating factor.
One thing I'll chime in and just make a comment. We're spending a lot of time on SPACs, but just in the reverse merger world. One of the interesting things, and I'll get into it maybe when I talk about Unum, that you can do in a reverse merger that you can't do in a SPAC. In a SPAC, you pretty much have to be, public ready in every way with a full team, ready to be in the public markets. What I've found on the reverse merger side is you can actually leverage the public company with which you're merging and their team. You may not have a public ready finance staff, but they probably do. They've been filing 10Ks and Qs and everything else. I did a deal, the Unum deal, where they had no management team whatsoever. It was an asset and you merged it into the company. The pubco ultimately managed that asset and then went out and tried to find the appropriate team for it. And that took 3 months post-closing, but the deal worked. And the other comment I'll make is, again, drawing distinctions, the average cash on the balance sheet of my clients last year was less than $10 million. Market capitalizations were quite low. It gave them a lot of maneuverability, the capability to do lower value targets, right? So one of the most successful deals we did was the Tokagen Forte deal, where the pre-money on Forte was only $30 million. That's not a deal that could have been done in a SPAC.
Yeah, and just tying into what Mike said about the winning and even kind of how you move over into that managing bucket as well is making sure that you are ready. But the other thing and it was a question that I saw too, was if you're a small company, you don't need to bulk up. You can use advisors, right? I know, Mike and your team, you guys can come in, advise. Stephen, you can grab advisors. We have interim folks to help. So you don't need to build up this huge, robust team to get to win and to manage it. You can use advisors who have been there, done that again. So you can stay pretty light from a respect to full-time equivalents. Just try to bring in the advisors who've been there, done that. And the same thing with IR. You don't need a IR professional in-house. You hire an outside firm to help you, win and then manage it going forward.
Since we're in the managing bucket, guys, one last question before we go to case studies, and we're going to run a little bit out of time here. We're going to do the case studies. Scott and David, if you could kind of go at a little bit of a pace on that, and any of the Q&A that's coming in, we got a lot of questions coming in, and a lot of them are valuation. How much of the company I'm going to give up. There's been questions on the role of warrants, right, and how that could be prohibitive to a potential M&A event in the future. It's going to be a very dilutive event. So there's a lot of great questions coming in from the panelists. So I really appreciate that. We'll take all those questions. We'll get back to you. We'll answer all the questions and get back to you guys following the webinar. So Mike, just to close out managing, what are the items a company should be ready for at this point of the merger process? Meaning how, once they get through the gate, once they win, and they're in this, they've merged, what are going to be some of the key success factors to managing?
Yeah, I think, if, for that question, if we're talking sort of post-close, there's all the standard public company areas that a company should be ready for. For example, a lot of earlier stage companies lack the ability to report and don't have a process in place. Scott Jansen mentioned this a little bit about investor relations, but don't really have a process in place to pull together key metrics. And so, I think it's important to use advisors through that process, but also having an eye on hiring the right people when the time makes sense for the company. I get a lot of questions around when should we engage with an accounting advisor? When should we engage with SEC counsel? When should we engage with other advisors? And really, if you just signed an LOI, it's probably too late at that point. We get a lot of calls where that still happens and we get engaged, but really if you're planning on doing a transaction, it should be at least a couple months ahead of time. So you can work your way through that process. But I think, in terms of sort of post-close considerations, there's financial reporting, which is probably the least interesting perhaps, but maybe the most important. And obviously if you're a new public company and you miss deadlines, you can, there's all sorts of ramifications. You can be delisted, there's shareholder suits, there's a lot of things that can happen from that. I mentioned technology, improving your processes, hiring the right team. There's quite a few different considerations there. Anyone else? I know this was open to a few different people, so I don't want to take all the time.
Yeah, Scott, I know that this is one of your sweet spots.
Yeah, exactly. Again, it's start early, bring in consultants. You don't have to build up your whole team. Bring in consultants and get that roadmap. It's all about that roadmap, the team timing to be ready, and that's huge. I mean, you can't start early.
Okay, excellent, guys. Thanks for just a riveting, really meaningful conversation regarding SPACs, from understanding all the way through managing after a win. Okay, let's go to the case studies, guys. We're gonna start off with Scott Jansen, who's going to talk about LifeSci Acquisition Corp. 1's de-SPAC with Vincera Pharma. Scott?
Yeah, I'll just fly through these because let's get to the Q&A. I think the key on this slide is I want to talk about timing, right? So the SPAC went public in March of 2020. After 3 or 4 months and dozens of meetings, they sent out an LOI to Vincera. Upon acceptance, the merger was announced at the end of September. And then we talked about that. The end of September to the time when the de-SPAC process happened was a couple months. End of September to it started trading as a combined company at the end of December. So I just want to kind of highlight some timing there. If we go to the next slide, I think this next slide has a point that we can address here. Some of the Q&A, I think the key takeaway is that talk about the Vincera insiders took dilution in order to receive the $65 million in trust. You can kind of see that on the right side of the slide. And then I think the other thing, if you right in the middle of the slide, talks about the incentives. So this LifeSci Acquisition Corp set up this SPAC with incentives, options, and warrants for Vincera to increase their ownership over time as they hit and achieve milestones. So I think that's really important if you're a de-SPAC. If you're a company looking to get into a SPAC, let's look at the T's and C's of a SPAC to make sure that they incentivize you guys, the operating folks, as the company hits milestones and goes forward. And then let's click on the next slide. This is just a really quick chart, compare and contrast, and I think these slides will be available for everybody, about the attributes of an IPO versus the de-SPAC process. We've talked about this. The costs, the timing can be better. The certainty can be better on a SPAC. The timing can be better. And I think, one thing here, the board control remained with Vincera, with 7 of the 9 members were of their choosing. So I think those are just some key things to talk about the Vincera and LifeSci Acquisition SPAC merger.
Yeah. Okay. Next up, thanks, Scott. This is David Strupp. I was going to talk about Kick and Unum.
Yeah, so this is a reverse merger. Our client in this case was Unum Therapeutics. Came to us almost exactly a year ago. The board had come to the conclusion that the best path forward was to go out and try to identify a private company with which to merge to really put their shareholders into a better place. We ran a broad-based process, went out to almost 400 companies, got 23 formal proposals, ultimately identified Kik as our merger partner. And stock was trading around 2 when we announced and closed that deal. Within a few days afterwards, it was trading at 12. What I think is interesting here is the concurrent financing here, and some of the investors are down the low right-hand corner. Some of the top tier healthcare investors out there, anywhere, supported the birth of this new company that's now been rebranded Cogent Biosciences into the market with $104 million. And it was interesting because this asset was coming out of pharma. There was no website. You had almost no information on what Kik was. That share price inflection was all driven by kind of that positive signal coming around that concurrent pipe. This company then went off. The other thing about this is unique, as I touched on earlier, no management team Kik. So again, something that could not be done in a reverse merger context. Also, valuation here, the pre-money of the acquired asset was below $50 million. Also something likely could not be done in a SPAC context. They went out, found a new team that's in place now. Took about 3-4 months to do so. And they did a follow-on financing of $110 million. So this company now is sitting, collectively between those two deals with over $200 million of new capital, and probably has, 5, 6, 7 investment banks covering them in research. So they largely have replicated, what they would have gotten in a traditional IPO context, and it's been a real success story.
That's great. Okay, guys, thanks, Scott and David, for those brief. One of the questions we're getting, and just Steve, again, just talk about the differences between a reverse and a SPAC. How do they differ?
One of the main differences is the sponsor dilution that you get out of a SPAC. So a SPAC, the sponsor group is going to own 20% of the outstanding capitalization of the company. So that dilution can be very difficult if you're dealing with a smaller transaction. And I think that's part of the theme, people saying, SPACs may necessitate a larger enterprise value in order to get a deal done, is that 20% sponsor ownership up front. There's also not a trust account up front of dry powder to basically supercharge the business. That comes from a SPAC. A reverse merger typically may have some cash on the balance sheet, which you can use, but they're structurally a little different. But again, there are a number of similarities in the context of it being an M&A transaction in both instances in order to take a private company public.
Okay, great. Another question is from Dan Parsley, GPG Houston. I know Dan really well. He says, to the point David Strupp about securing a quality pipe investor prior to seeking a SPAC or a reverse merger, can you elaborate on the stage or progress of the company necessary to secure a meaningful pipe capital, and how much is a meaningful amount to move to gain the attention of a SPAC in a reverse merger?
Yeah, that's a good question. I think it's probably more of an art than a science, right? It's going to depend, I think, largely on the facts and circumstances. There is a minimum, I would say, that probably feels like $20-ish million or more, that's providing that sort of seal of approval. Again, it's going to depend somewhat in terms of the, it's 20 relative to the capital and trust, relative to their needs, quality of the investor syndicate, et cetera. In terms of stage of development, again, it really depends on the therapeutic category, man. You can be an oncology company preclinical, and valuations are quite high, and investor interest is very high. Other therapeutic categories, you need to be much later stage in order to attract the capital. I also furthermore say, just to be clear, our approach of sort of looking for those companies that have it all pre-baked is really unique. I don't think very many others actually look through the same lens that we are. Most SPACs are out there, they go identify an interesting company and then go figure it out thereafter as kind of partners. And I think our approach is probably very different than 95% of the other SPAC teams out there that just say, hey, let's go find ABC, Pharmaco. We think they're really interesting, and we think they're good enough, interesting enough that we'll go get the SPAC together or get the pipe together. So, again, our approach is a little different.
And David, I think that's a great and it's a unique approach because, as you said, a lot of SPACs, they identify a target, they find it an LOI, enter into an LOI based on a certain valuation, and then they let the pipe concurrent financing after the fact, bring the valuation back down to reality. So that can waste some time in the process. To your point, you kind of cut that out with your proposal, which I think is great.
Yeah, I mean, look, I can think of 2 deals I did last year. They happened to not be SPACs or reverse mergers, but a similar concept where in one case, we decided to merge with a company with the idea of a concurrent $40 million concurrent pipe. 15 was coming from insiders. The rest was supposed to come from the outside. And in the end, they didn't get a penny more besides the 15 from the insiders, which was not the preferred outcome. And then in another deal, we ultimately did get the pipe capital that we wanted. But in seeking it post signing the term sheet, we must have burned up 4 months of time trying to get the investor capital. And our view is there's enough companies out there that are already in a financing posture that the pool is big enough that for us to select from, that we like our strategy.
Okay, guys, we're running up against the hour here, so I want to be really sensitive of everyone's time, participants and panelists. How critical is it to have audited statements from the Big Four versus from other PCAOB registered firms? Can we talk a little bit about the auditing, Mike, Scott? That's necessary to close one of these SPAC reverse merger transactions.
Sure, I'll jump in and to start off, and I would say that no, it's not necessary. I think there's probably some sentiment around Big Four versus non-Big Four for investors, and I don't claim to understand exactly how every investor thinks, but I do think that there is some sentiment that typically a Big Four auditor may result in less restatements of audited financial statements. Maybe there's more confidence in filed financial statements, but we've worked on SPAC transactions that are closed and are now trading that were audited by non-Big Four firms, and they were very successful, and the process was successful, and so I don't think it's required, but I do think that there is some sentiment around confidence with Big Four, audited companies.
Yeah, I'd concur with that. You can go with a variety of different firms, and then you're also part of it is you're going to try to find a firm that fits with you, and also part of it is timing. There's so much activity. Again, plan early, because you can't just call up a firm and have them show up next week.
One last question. I just thought this was kind of interesting. Most SPACs are 1-to-1, right? You got cash and trust, right? And then you got one company, and you got a concurrent financing. A couple of we're talking about, how about multiple companies going into a SPAC, right? And then how does that affect the redemption feature? Can you redeem out of one and not when one's announced? I mean, Steve, I haven't really seen a lot of these multiple companies, type of de-SPAC scenarios. Can you speak to that real quick?
I haven't seen it in life sciences, but I've worked on deals where we've acquired multiple companies. Last summer, we represented Act 2. It acquired Marisont and Mafco. Those were companies under common control, so there was financial statements presented on a combined basis. We are involved in deals now where you might have an M&A transaction, and then that combined company gets acquired by a SPAC. So there are certainly mechanisms where you can aggregate companies and convert it into a public company post-closing. No prohibition on that. Generally, the IPO prospectuses do state that you won't acquire 2 companies in different verticals, because that's obviously the difficulty. But same vertical, it's definitely been done before.
Appreciate it. Well, guys, it's been a great discussion. I just really want to thank all of you for your time and effort. It was, I really learned a lot as well during this process. Thank you to the participants. Thank you to our host, ShareVault. I'll hand it over to ShareVault for the close.
Absolutely. Well, thank you so much, Scott Jordan, Scott Jansen, David, Mike, and Stephen, for sharing your vast knowledge with us. And thank you to our audience for joining us today. Be on the lookout for an email in the next few days that announces the availability of the recording and slide deck. We sincerely hope that the information you received today will be helpful to you. And on behalf of everyone here assembled today and the ShareVault team, we wish you good health and a wonderful remainder of your day.
Thanks, everybody.
Thanks, everybody. Cheers.
Thanks so
Thank
much.
you.
Thank you.